Did you know that the average inflation rate worldwide is about 3.5%? That means if your money isn't growing at least this much, you're losing value. Investing in stocks can help you beat inflation. Now you might be wondering, what's the big deal with inflation? Well, inflation is like a silent thief, quietly eating away at your savings. If you're not careful, it can leave you with less purchasing power than you started with. That's where investing comes in. Think of investing as a shield against this inflationary thief. When you invest in stocks, you're essentially buying a piece of a company. As that company grows and prospers, so does your investment, growing your wealth over time. The key here is time. The longer you stay invested, the more your money compounds, turning a small snowball into a mighty avalanche of wealth. Now I bet you're thinking, how do I start? Don't worry, we've got you covered. Please subscribe and follow to our channel. Tip number 6, start early. The earlier you start investing, the more time your money has to grow. Let's dive a little deeper into this. Have you heard of compound interest? It's the interest you earn on your initial investment plus all the interest that accumulates over time. It's like a snowball. It starts small, but as it rolls down the hill, it picks up more snow and grows larger and larger. The same principle applies to your investment. The sooner you start, the more time your money has to roll down that hill and grow, thanks to compound interest. This growth can be significant, turning small, regular investments into a sizable nest egg over time. The key here is time. The longer your money is invested, the more potential it has to grow. So there's no time like the present to get started. Moving on to tip number 5, choose your stocks wisely. Now there are 2 primary ways to go about this: technical analysis and fundamental analysis. Technical analysis is all about studying statistical trends, such as price movements and trading volumes. It's like reading the market's pulse. You're looking at patterns and trends in the market to predict future price movements. On the other hand, fundamental analysis is a little more in-depth. This involves evaluating a company's financials, industry position, and market conditions. It's like peeling back the layers of an onion to understand the core of the business. Both methods are tools in your investing toolbox. Some investors might lean more towards one than the other, and that's okay. What's important is that you're making informed decisions based on research and analysis, not just going with your gut or following the crowd. Remember, knowledge is power in the world of investing. Tip number 4, don't put all your eggs in one basket. This age-old adage still holds true, especially when it comes to investing. Diversification is a risk management strategy that mixes a wide variety of investments within a portfolio. The rationale behind this technique contends that a portfolio constructed of different kinds of investments will, on average, yield higher returns and pose a lower risk than any individual investment found within the portfolio. It's like crafting a balanced diet for your finances, ensuring that you have a mix of assets that can weather different market conditions. One way to achieve diversification is through index funds. An index fund is a type of mutual fund or exchange-traded fund with a portfolio constructed to match or track the components of a financial market index. This way, instead of trying to beat the market, you're trying to be the market. The beauty of index funds lies in their simplicity and broad market exposure. They're a great tool for those who want to diversify their investments without the need to constantly monitor and adjust their portfolio. Remember, diversification doesn't guarantee profits or protect against losses in declining markets. But when done right, it can help you navigate the ups and downs of the market with a bit more ease. Diversification can be your best friend in the unpredictable world of stock investing. Tip number 3, consider bonds for stability. Bonds, in essence, are loans that you give to the government or a corporation. In return, they promise to pay you back with interest after a certain period. The beauty of bonds lies in their relative stability compared to stocks. While stock prices can swing wildly based on market sentiment, the return from bonds is, for the most part, guaranteed. This makes them an effective counterbalance to the unpredictability of stocks, adding a layer of security to your investment portfolio. But remember, stability often comes at the cost of lower returns. So while bonds can provide a safety net, they might not generate the same level of wealth as stocks over the long term. Bonds might not be the most exciting investment, but they can be a safe haven in stormy market conditions. Finally, our top tip, number 1, keep your eyes on the horizon. It's easy to get caught up in the daily fluctuations of the market, but successful investing requires a long-term perspective. The stock market has its ups and downs, but over time, it has consistently trended upward. To maintain this perspective, it's important to set clear long-term goals. Are you saving for retirement, a home, your children's education, or perhaps a dream vacation? Having a specific goal in mind can help you stay focused and resist the temptation to react to short-term market volatility. Consider this. If you're investing for a goal that's 20 years away, does it really matter if the market drops a few points today or tomorrow? Probably not. What matters is the overall trend over those 20 years, and history shows us that more often than not, that trend is upward. Remember, investing is a marathon, not a sprint, so set your goals and keep a steady pace. So, to recap our top tips for beginner investors, begin your investment journey as early as possible to reap the benefits of compound interest. Choose your stocks wisely, using technical or fundamental analysis to make informed decisions. Diversify your investments to spread risk and consider the stability that bonds can offer to your portfolio. Lastly, maintain a long-term perspective, focusing on your ultimate financial goals. Investing might seem daunting, but with these tips, you're well on your way to making your money work for you. Don't forget to subscribe and follow for more financial insights. Happy investing!